All right, give me a sec. The recording started. All right, let's do a deep dive into the 6-step strategy. Now, I want you guys to build confidence in order to take trades based off of trade ideas. Yes, Premium Group is a signal group, but I want to build confidence, skill, and get you guys the ability to start trading on your own and not always just rely on me to send setups all day. Because like a day like today, where I unfortunately had some personal things that I attend to that I could not get in front of the charts the whole day, then everyone just sits and waits. So I would like to be able to share an idea, a setup, a zone, a whatever, and I want you guys to have the skill and the knowledge to be able to react on what I'm sharing. I will give you market direction. I will always make sure that you guys know in which direction I'm expecting the market to go. Now, learning the 6-step strategy will give you guys the ability to actually execute the trades accordingly at the right time and the right place without me having to spoon feed. All right, so let's dive into the 6-step. On the screen, can everyone see my screen? Just gooi me a thumbs up. I just want to make sure that it's sharing properly. Everyone can see it. How's the quality? Do I need to zoom in a little bit more? Everyone can see it and you can read it. Okay, great stuff. So we've got two types of 6-steps. Two types. Number one, a bullish 6-step. And number two, a bearish 6-step. A bullish 6-step means we are stepping up, we're climbing a ladder upwards, we're climbing stairs upwards, we wait for the sweep at the downside, and then we take our trade up. A bearish 6-step, opposite, we're in a bearish trend, we wait for the bullish manipulation, and then take the trade on the trend continuation. So these are the two setups. This is what it looks like. Take a screenshot, take a picture, do something, because I need you to imprint these patterns in your mind. The bullish one is always easier to spot and easier to trade. Bearish is a little bit more difficult because it's counter trend. I said I was going to let people in for the last 5 minutes, so let me just get everyone in here. Okay, that was the last. Okay, that was now the last. I'm not going to accept more people. Otherwise, it's just too distracting the whole time. Okay, so imprint these patterns in your mind. Take screenshots. Save them. I mean, this was posted in ChartFlex. So if you guys can even save this, go into your trading view. You can literally go to this icon down there. Sorry, text. You can go image, and you can download them and save them on your chart so that you can move them around with you to learn the pattern. This is the important part. So back testing is extremely important. I'll end off to show you guys how to back test, but let's just start at the basics. What is a buy 6-step? What is a sell 6-step? Buy 6-step, this very first, we all understand breaks of structure. We all understand market structure. And if you don't understand market structure, I've made quite a few videos on YouTube, on the Discord, everywhere where I explain market structure. I think in the Telegram group, there's also some videos that explains market structure and dumbs it down for you to understand. But a break of structure is every time the price, before we go to a real chart, I want to just focus here. Every time price makes a low and then breaks the previous high that created the low. So we have a high, we have a low, a higher high. Means price broke through that previous level. Price pushes through. It then makes its pullback and then pushes through again. So we have a low, high, low, high. Okay, so this sequence, two of these gives us our basic 6-step. Yeah, okay. So, like, I want people to learn, so let them in. See, it puts me off my story the whole time. So two of these structures is what creates the 6-step. That's the starting point, the fundamental block of the 6-step. But can you see here that we don't skip structure? Meaning, We don't use a high that was printed here, and then there's structure, and then a high that's a low. We don't skip structure. It has to happen in a sequence. It has to happen after each other in order to be a valid six-step structure, meaning we have to have a high that creates a low, that creates a higher high, that creates a low and a higher high. Sorry, let's move this down. We have to have this sequence happen directly after each other. And the perfect way to do this, if you draw a line across, we always want a shallow tap. A deep tap invalidates the potential of it holding. A shallow tap is way better potential. So if we have to look at, this would be an A plus setup. Less than 50%, but deeper would still be a setup, meaning it could still hold. Deeper than 50% would be a B setup. B setup means we don't necessarily go full risk. We reduce our risk size, or we wait for the low to get taken and then get a reaction before we take the trade, because there's less confidence to execute the trade on our normal risk size. So what I normally do is, if I have a B setup, I would then reduce my lot size in half and then still potentially take an entry. But because I'm reducing my lot size in half, I would increase my stop loss a little bit bigger. I would make my stop loss not under the 2, a little bit bigger, because the chances of this 2 getting swept is great. It's like more likely than not 2 will get swept. And knowing that 2 gets swept, why don't we just wait for it to get swept and then enter? So by waiting for it to get swept and then enter, then we can get the play through. So all about timing. You've just got to ask yourself the question, if I place my stop loss at this low, what is my risk factor? What is the chances of me losing money here? If this is so close to each other, why would price not take both lows? Why? What makes you think that it will react here and not take this? So we always play it safe. We always take a lesser risk, or sorry, I am Afrikaans, so please excuse if my English bundle runs out. So if we do take this trade and our risk factor is too high, meaning the chances of our stop loss getting taken is higher than 50%. And what does 50% mean? That means how deep is this in? Is this at 50%? Then it's a 50-50 trade. The deeper this goes in, the higher the risk. If this is retraced 60%, we have a 60% chance that our stop loss will get taken here. If this traces back 90%, we have a 90% risk factor. You guys get where I'm going at? The deeper our liquidity is resting, the higher the risk our stop loss level will get taken. So that's the first and most important thing that I need you to understand of the 6-step. The shallower the tap, the lower the risk. Okay, that's why we want a shallow tap back into the zone. So again, very, very simple way to identify is you go to your rectangle and you draw a box from the high to the low and you pull it through. Your rectangle gives you your 50% line. So if liquidity is resting at 50, it's a 50-50 chance that this low can get taken. If it rests shallow, we know 20-30% chance that the low will get taken. So that's a good risk to reward factor. We then, where do we place our trade? On the 50%. That is where we look to enter our trade. Why? Because we want price to return into the 50%. We don't execute when it gets to 50. We want to see a reaction and a push up. And then when it breaks through the 50, we take our trade at the 50 with our stop loss at the low. And then we let price do its thing. Okay, so that's how we enter a 6-step. Hope everyone understands. Thumbs up. Everyone understands that. Thumbs up. Cool. You understand the risk factor. You understand how to calculate the risk factor on when to execute a trade and when not to, when to reduce. So anything 50% and lower, we reduce our risk. If liquidity is 50% or lower, we reduce the risk, meaning we go smaller lot size. Okay, just because we don't know if the zone will hold. So why take a full loss if we don't know? If we're unsure, but remember, by trading systematic, when the system says we do that, we have to execute without emotion. You have to take the trade if the system says you have to, meaning all the boxes are ticked. Here's our boxes. We'll get to that in a moment. When we have a system, we remove emotion. So let me write this because this is extremely important. A system, let me clarify, a rule-based system removes emotion. If you are struggling with emotion in trading, with emotional decisions, moving your stop loss too quickly, entering the trade and feeling like you're going to get anxiety and you don't know and you go ice cold and I don't know, all these funny emotions. I just remember what I used to get back in the day. When you enter a trade and you have fear, it means you don't have a system. You're not following rules. You're not following your plan. If you have a plan and you have a system and you're following your rules, you can't be scared because you're doing what you're supposed to do. So entering a trade without a system or without a rule-based system is like bungee without a rope. You're for a hell not going to jump off there if you're not guaranteed and know for a fact that your feet are tied up to the bungee cord. It's like jumping off of without a rope. If you don't have this, you are bound to fail because emotion, we can have two exact same trades, 100% the same trade. I can show this zone to two traders, exactly the same, and their outcomes will be different. Why? Because of their emotional decision making. One will potentially close the trade too early. One will take the trade too late. The other will take the trade too early. The other will move his stop loss too quickly. The other will not have a stop. You get what I'm saying? There's too much factors that humans and our emotions can control when trading. So this is extremely important. This rule-based system, meaning if that gets there, then I always say, if that, then this. If that happens, I do this. Simple. I always have to have, if that, then this, before the time, because then I've got nothing to worry about. Okay, so enough about that. Let's just all remember a rule-based system removes emotion. If you're struggling with emotions, it means work on your system, work on your rules. Okay, key driving factors in order to take a 6-step. Number one, we need a change of character or BOS. We all understand that. We have a BOS. The best 6-steps is when we have a change of character followed by a BOS, meaning a change of market trend following a BOS. That's the start of the trend. So an example would literally be something in the line of this. Example would be we have a bearish trend stepping down, sweeping liquidity, stepping down, sweeping liquidity, stepping down, coming up, fail to make a new low, change of character, liquidity, break of structure. Now look at this. Everyone with me? We're stepping down. We sweep liquidity because a low was made high. Then we fail to make a new low. So this shows us intent to shift market structure. So I make this bigger. Can everyone see this? Okay. So we swept liquidity to the downside. We created a low. We left liquidity and we left liquidity. This would be our target. Why would this be our target? Because this was the last liquidity sweep before the low was created. So if we take a trade from here, this would be our target to trade into. So price more than likely would react from this zone. It will push into this. It will react from here. It will sweep our liquidity and then trade through. Because whatever happened to the left will engineer the path for the future. It's amazing how this happens. Once you start to see it and you read it, you can already determine where price is going. For instance, last night, I tried to take the buy. Yes, our timing was slightly out, but the move was still legit. The move still went. Everyone was still trying to sell. Everyone was thinking price is bearish, and Asia session came and ripped a new one straight to the Eiffel Tower. Like, so Asia session is cooking lately, like seriously. All right. So then we get that. This is our change of character. Why? Because this is the very first leg that failed to make a low and shifted in structure. Price then pushes up, taps in, gives us that liquidity, and then POS to the upside. This formation is absolute gold, because once you have this, you have an entry point, you have an exact area to look for your entry, you've got a target, you've got liquidity, you've got everything. This is all you need to take 1 or 2 or 3 solid trades for the day, and you are done. Because, for instance, this gives you the opportunity, irrelevant if this is on a smaller time frame, higher time frame, whatever you're comfortable with. We don't have to hit home runs all the time. That's not the point. Think about it this way. If we enter a trade, if we now know we've got a high success rate taking a trade in this specific area, we can increase our risk size to make more on one trade. So instead of trying to scalp and in and out the market all day long, you can wait for that one good trade every day and make your money. So for instance, if we now have this set up and we know, okay, we have our liquidity that was swept, we have this low, we have our liquidity that was created, we need to wait for price to return to this level. Sorry, is my sound bad? Can you guys hear me? I saw a thumbs down. Sound good? All right. Okay. I don't know why I heard a thumbs down. All right. So we have our liquidity that was swept to the downside. We have our market structure shift, and we have our liquidity that was left behind. All we wait for now is price to return to this level. Where do we know we want to take a trade from? If we draw a rectangle from that high to the low, I want to get involved in this trade either on the 50 line or below. Either on the 50 line or below. So we have to look for POIs, but we'll get to POIs. I just want to show you the method and the thought process of how the 6-tap was developed. Okay, so if we take a trade, let's say we take it on the 50 line, our target would be wherever this 5 leg stopped. That would be our ultimate target. Why? Because if we are continuing trend, we're expecting price to break that high, right? Simple. So that's our target. If this is our trade, look at this risk to reward ratio. 3.7 risk to reward, which means I'm risking $100 to make $370. Just using round figures. I'm not saying you guys must risk 100. Let's use a round figure. If I'm risking $10 here, I'm making 3.7 risk to reward, which now means if we know we've got a higher success rate out of this area, we can increase the trade size to make our money from one trade. And we're in and out and done. Now, how do we determine this? Your account size, your trade risk must never, ever, ever, ever exceed more than 30% of your account size. So a $100 account means you can never risk more than $30. That's excessive. But if you're taking 1 to 2 trades a day max with this sort of risk to reward, it makes sense to risk 30 to make 3.7 your money back. We think percentages. We don't think dollar amounts. I'm risking my personal account, I risk 1% to make 2% minimum. That's how I trade. That's why I take 1 or 2 trades a day. I don't overtrade. I don't revenge trade because every trade I take, I have to risk 1% of my account size. And I'm only allowed to lose a maximum of 2% in one day. That's my rules. Now, again, remember, a rule-based system removes emotion. I never worry about how much money I'm losing because I know what is the maximum amount of money I can lose in one single day. I've already accepted it. I'm already happy with it. I can move on. That number doesn't vary. It's not a variable factor. I don't move my stop loss. If price takes me out here, it takes me out. So it means my planning needs to be better. In a situation like this where these two levels are so close to each other, remember what I said? More than 50%. So where is 50% of that zone? We are deeper than 50%. Remember what I said? What is the chances that this low can get taken? More than 50%. That means we reduce our risk, increase our stop loss. That's how I want you guys to think about this. And this will keep you out of shit trades so many times because what will more than likely happen, price will sweep this low as well, just wick it out, react off of this supply or demand zone, and then go in your favor. Serious. It's incredible how this system has changed my trading completely. Okay, so does that make sense to everyone? You all are clear on how to physically execute the trade. All right, now let's dive into the actual 6-step strategy. Let's see, why can I not? I want to clear this. Clear that. Okay, let's dive into the 6-step strategy. Very important. We've got the bullish, the bearish, change of character, liquidity, POI, major levels. What do we mean with major levels? We want to take a reversal trade from higher time frame liquidity points, previous session highs or lows, 4-hour highs or lows, daily highs or lows. You need these key levels to expect a reversal. And we only then take a lower time frame 6-step out of a higher time frame level. So that means if we go into a 4-hour or a daily time frame and we know we've just swept previous day high or low, we're expecting a reversal. Right. Now we drop time frame to look for the 6-step in the direction that we are intending to trade. So let's draw, before we go to a real chart, I want to just draw this example. We are bullish. Price is bullish. We are approaching a major 4-hour zone. All right. So do we just take a trade out of the 4-hour zone just with the first reaction? No. We literally wait for this. Because if you'll notice, our first 6-step was created here. 1, 2, 3, 4, 5. That's our bullish 6-step, which means we have liquidity here, which means we need to get a reaction out of this level. We need to make 100% sure that this is not going to flip and turn back to bullish again. So we need to wait for price to return, sweep liquidity, and then give us a zone. So normally, hang on, we would have it like this. Price will react there. It will do this. It will do that. there will most likely be a fair value gap or something as an example. What price will then do is it will flip up. It will now sweep our 6-tap liquidity and then give us the trade down. So what did we actually do? We made sure that our bullish 6-tap reaction that we got here did not give us a break of that level. That's the most important part. Once this happens, and we can see that this was just a sweep, remember what we said, 50% level there. That's where we enter the trade, our stop loss above that level there, and we target lower lows. We can see liquidity, 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 and we can target these lows. So that's how and why we look at entering a trade. Is everyone with me on this? We don't enter there because we don't know if price will just continue through. Nothing stops price to continue through there. We make sure that it fails to give us a new high. Sorry, this trade is in the wrong direction here. Short position. We don't try and top and bottom tick trades. That's not the purpose of what we're trying to do. All we want to do is get the confirmation and take a small piece of the pie. I don't want the whole pie. I just want a small piece of the. Yes, Piet. Did you raise your hand? Question?
Yes, I did. I just want to ask you something like in this example you're using here.
Yeah.
Like this market was already ranging from previous that showing high highs, lower high highs, lower high lows and all that.
Yes.
Where this is where I'm struggling with. There's a change of character, and after that followed by BOS. That's perfect. That I can see 100%.
Mm-hmm.
In a market that's already ranging, where do you start your tap one?
Are you specifically talking about this range here?
Yeah, like
the bullish
this,
range,
where
the ranging range.
Ranging,
okay.
And you're looking for to enter with to place your first tap, but
okay.
you did not have a change of character. That's what I'm struggling with.
100%. Okay. I only look for 2 6-taps back. The only most recent 2 6-taps are important to me. You don't totally disregard the previous, but I only keep drawing new ones until the 2 most recent ones are relevant. Meaning.
All right.
Okay, so meaning.
So you can almost use it like the 6 taps backwards matter.
Okay, so let's look at this. We have now this entire range that's pushing up here. So you basically start with, I'm going to use this tool. That would be your 1. That will be your 2, 3, 4, 5. Right? We all agree. That's simple. That we understand. Now, what do we do with the new range? Simple. That previous 3 is now your 1, 2, 3, 4, and 5, and you just keep drawing it. As long as it's giving you new structure to continue, you continue to draw it, because the most important thing to realize is, was liquidity swept before new structure was created? No, it has not. So this level remains valid liquidity. This is the inducement. This is the trap that the market prints, because this is the liquidity level for it to react from on the way down. So what it will do at these levels is it will bounce. It will bounce these levels. And when it bounces, what has it done again? Left new liquidity for the way up. And then the cycle just continues. That's all it does. It just fills these liquidity gaps going up and going down. Simple. And that's how I'm able to read the market and understand where we're going, why we're going there, and when we are potentially going there. Because I look at where liquidity is building up and I trade towards the liquidity. Once you read this, you learn to print money. Money doesn't grow on trees, but fuck it, we can print it using this. Okay. Pierre, does that answer your question, eh?
Yeah, 100% asked and answered. Thank you.
Okay, so very important. I'm just going to recap on this. If we have a lower zone 6-tap, so that's a 1, 2, 3, 4, 5. I think let me use the numbers to illustrate it properly. So that would be a 1, 2, 3, 4, and 5. Okay, everyone got that. Now, because we've got new structure, we had a new low that didn't break the previous low. So liquidity was not swept and new structure was created. This then becomes a new 1, 2, 3, 4, and 5. Remember that these lows that don't get taken remain 4s. 4 is our liquidity. If a low is not swept and a new high is created, that low, whether it is a 2 or a 4, it is liquidity. Important to understand. Only when it is taken and a new high is created and structure is broken, this then becomes our protected level. Important. I always mark it on my chart with a nice thick black line for me to remember. This is now our protected level. So anything before that, irrelevant. I don't care. I'm not interested. Everything from this level up, I want to look at liquidity. Once price breaks this level, I'm shifting my bias from bullish to bearish. Now I only look for sells. Why? Because we've broken a key structural level. So if I'm expecting the market to reverse, and US session loves to do this, deep sweeps, it will usually be to these levels that were printed earlier during the day. So as long as liquidity is not swept, this key structural level remains stationary. It remains at one point. As the market starts producing liquidity, let's say this one sweeps there, no problem. We move it because liquidity was taken before structure shifted up. That's our rule. That's our structure. Okay, so you just keep drawing the 6-tap. So there's 1, 2, 3, 4, 5. Let me just get that 4 back. 1, 2, 3, 4, 5. And then same thing again. That would be your new 1, 2, 3, 4, 5. And that would be your new 1, 2, 3, 4, and 5. So you just continue. But when I'm in a specific area and I'm seeing shift, I want to look 2 back. So I can see there's liquidity, there's liquidity there, there, and there. So this gives me way more confidence to trade into all of this. Make sense? Thumbs up, guys. Make sense? Now I've got deeper targets to trade into with more confidence to hold the sell trade because where's our liquidity? To the downside. That's it. And if you read this liquidity, you'll be able to take more successful trades. DAX is currently a good example of this. Let's have a look. You mean DXY or do you mean German?
German.
Okay, let's look at German. Yeah, very messy, but yes. Look at this trade that I shared this morning. Look at this. I showed you guys the 6-tap. 1, 2, 3, 4, and 5. Returned, swept liquidity before breaking structure. So what does that mean? It means that this level is now our structural support level. Our major structural support level is here. Okay. And if this liquidity here is swept and a new high is created from this level, what then happens? We move this up, structural support level. Why? Because it's swept liquidity and shifted structure. So it shows you that eventually, when we break this level, we can then look for that retracement confirmation for the sell and then catch a 6-tap, which will happen like this. It will sweep that area. Price will then flip, tap into a POI, SND, fair value gap, something in that area. Sweep this liquidity and then continue the trend down. Your most important thing as a trader is to not trade. The biggest mistake I see guys make is they try and sell on this break and they try and buy on this break. How many times, and you guys can just think about this, how many times have you ever in your trading journey placed a trade, a buy trade, and then boom, it dumps, stop loss. Then you're like, okay, this is going down. Then you sell, then boom, it buys, stop loss. Then you think like, what just happened? It buys, then it's selling. You are totally confused. You don't know which way. That is this move. That is why it happens. This is how it happens. It's inducing liquidity. It wants those retail traders to step in at key specific points to take your money. So if you learn to wait for specific things, the chances if you know you've got liquidity above and we break the structural level and we get that reaction out of a area, meaning potentially this fair value gap left behind here, that's a POI. If we get the reaction of the fair value gap, what can we do? We can potentially look at taking a buy trade, small stop loss, small risk, and we target that liquidity there. We can take a buy into that liquidity. Once we tap that liquidity, you take your profit and then you wait for reaction, and then you can take your sell trade from there. Stop loss above there, take that trade, bam. 2 trades, less than 2 minutes, you've made your money and you carry on with your day. I'm making it sound so simple because it really is that simple when you understand this model. The 6-step model will change the way you see price, because this is how it works. This is how it moves. I don't want to clear all those drawings, otherwise I'm going to remove all the stuff I've done. Look at this. Let's look at this clear damn example. And I mean, by just quickly looking at this, there's liquidity. It swept liquidity. It targeted the high. When it targeted the high, what did it do? It made liquidity, broke the high again, swept that liquidity, returned, take liquidity to the low, tapped into the supply, and boom, up to the top again. So in a matter of just the space, obviously on a smaller time frame, you are able to take multiple trades. And again, Germany's cheaper to trade. S&P 500 is cheaper to trade. NASDAQ is cheaper to trade. So your mistakes doesn't cost you so much. I really encourage you guys to go look at German, to go look at NASDAQ, and I'm encouraging you, especially S&P 500. This pair is incredible to trade because when it goes, it goes. Think about it this way. S&P 500 stands for Fortune 500 companies. It's 500 company stocks that you are trading. It is less volatile. It moves with intent. It doesn't manipulate. Does, but not as much. It's not gold. Gold is influenced with almost everything that's happening in the world. It is so volatile. If Trump opens his mouth, gold will jump. S&P 500 not. German not. They don't give a shit what Trump says. Yes, if it affects the dollar, different story. But it's simple. S&P 500, we can directly correlate again with the dollar, and we can use NASDAQ and S&P 500 to get an idea the same way we use gold and silver. Guys, I'm going completely off track here, but I just want to really encourage you guys to explore other pairs. Gold is phenomenal, and we all make a shit ton of money with gold, but it's costly. If you make a mistake on gold, it costs you. If your account is smaller than $300, you should not just be focusing on gold. All right, but unfortunately, that's the only place that everyone is always interested in, is gold. But I mean, look at this. All of this is clean structure. Every so often, we are creating return, liquidity sweep, new structural level, return, structural level. So there we had 2 breaks, 1, 2 breaks. But look at this liquidity. Remember what I said. The chances of our risk factor is too high. So we won't necessarily execute a trade here. But this was the last liquidity sweep before structural low was created. So this was a very strong area to trade from. That's why price reacts from it twice, because that was your structural level right there. That was a last liquidity sweep before structure was broken. So did this high sweep liquidity? No, it did not. So structural level remains at this level, and we now look at trading low. Here we can see liquidity was taken. Right, now this moves there. Now we carry on. I'm not too bothered about up there. I'm now only focused from this level down. Where will price return to? Look at this. And I didn't look, but I knew. Simple. Just by following structure. Simple method. All right, so if we look at the 6-step, the areas that we potentially look to trade from, let me just go back to gold here so I can just get my notes. There we go. The areas that we look to trade from, we've now covered a change of character BOS. We've covered our liquidity in depth. POIs. Let's go look at some POIs. Let's explore some POIs. If we have a zone from there to there, and we draw a cross, I'm always looking at the center line because that's where I want to potentially trade from. So what POI matches my center line? We can see this beautiful fair value gap right there. Boom. That's our level. I want to see a reaction out of this level. If price pushes through this level, then I'm looking at when it retests, is it going to break through or is it going to retest and push down? Because I can take 2 trades. I can either take a buy from here up or I can take a sell from here down. I don't care which way it goes. I just want to jump in whenever it goes. I'm not predicting. I'm not emotional. I'm not. I sent a message to someone earlier, no, to Andre. Let me just read that because I worded it actually flippin' perfect. We don't hope. Let me just see here what I said to him. Sorry, guys. Give me 1 sec. Andre, say any chat. Andre. I said to him, we don't hope, we don't guess or predict, we react. We don't hope, we don't guess, we don't predict, we just react. Whatever price is doing, we just react to what it does. Simple. I don't care if it's going to go up or if it's going to go down. I just want to go with it when it goes. So our system removes emotion. Again, POI from the 1 to your 2. So you always look at between 1 and 2. Between 1 and 2, you look for a POI. I'm not interested in anything above there. I'm interested in between this level. What POIs do I have? Fair value gap. Plus, I've got this base. Rally base. So this is another POI. Let me just clean this up. Sorry, guys. Let me clean this up. So we've got POIs. We've got a fair value gap. So I mark it. Fair value gap. There we go. Then we have a base. That's another zone that price can react from. Now that's 2 levels that price has to break through before pushing down. Actually 3, because we also have a supply and demand zone here. So we've got 3 layers of protection. Think about it that way. 3 layers of protection that price has to break through in order to take us out to get to our stop loss. Okay, that makes sense. We've got a base, which is a form of supply or demand. We've got a fair value gap that it's got to break through, and it's got to break through this area of demand in order to get to our stop loss. So with all those layers of protection, I feel very strongly protected, meaning I will more than likely take a full position from a trade here. I just need to see which zone will it react from. And in a case where it's got 3 zones like this, I'm more interested in the bottom one, in the middle one, and the bottom one. The top one, more than likely to break. Why? Because if I take this range from this to this, where's my 50%? I'm only interested below 50. Why is that? Who can answer me? Why are we only interested in the bottom 50% of this range? Why is this range here our only interested trading range? Can anyone tell me? Anyone? Going once, going twice. Come on. There we go. There we go. That's the answer I wanted. Top area we consider as premium. Bottom area we consider as discount. So if we want to buy, do we buy in premium? No. We want discount. And that's the model. And that's how we know where we want to take our trade from. That's now the responsible thing to do is sit on your hands, be fucking patient, and wait for a reaction out of your level. Don't be a chop and think because we have this, we can now sell into this, because look at what can happen. When price is reacting from here, you can't just take a sell and think, there's my zone. I'm just going, and this was me in the beginning. So I'm speaking of experience. Don't be a chop like I was and think every time because you have identified a zone, you can now sell into your zone. It doesn't work that way. You have to wait for a reaction out of the zone to take a trade. We don't guess. We don't hope. We don't predict. We react. Ask yourself before you're taking a trade. Are you guessing? Are you predicting? Are you hoping? Or are you reacting? Before you push that buy or sell button, ask yourself, am I reacting from what I'm seeing? Or am I guessing, hoping, and predicting? And that's going to keep you out of shit trade, guys. Promise you. All right. So that is zones, POIs. It's simple. Rally base. Why is it a rally? Aggressive push up, pause, aggressive push up. It's a rally. Price is rallying, it's pausing, and it's continuing. And you have that in various directions. Even in a downtrend, in an aggressive down move, you have the same thing. Looking for example here. There we have a aggressive push, a pause, an aggressive push. So that is a base. We expect price to react from bases, whether it's positive, negative, but a base is also liquidity because it's an area where other traders, retail traders, will try and trade from. So we need to be careful. We need to look at liquidity. Use this liquidity map. Remember what I'm telling you to focus on. Was this high swept before changing structure? No. Was this high swept before changing structure? No. Was this high swept before changing structure? No. So by doing lower lows without sweeping liquidity, what are we doing? We are creating an opportunity for us to take a trade into liquidity. Simple. Everyone with me? This is the easiest way I can possibly think of explaining this. And I really hope this makes a huge difference in your trading, in your journey. But let me promise you one thing. I was once a struggling trader. I had to figure the shit out. Unfortunately, I didn't give up. Not unfortunately. I did not give up. I'm too strong-willed. I'm a sporting person. I play rugby. I hate losing. I'm competitive. So when I felt like I was failing, I just got more determined to succeed. And I managed to figure the shit out. So, guys, Forex Evolution is built, and I'm growing this to be one of the most successful, not me successful, the most successful, profitable community in South Africa. That's what I want. I want your success. Your success determines my success, not mine. I'm already making money. I can move overseas. I can follow Justin and go to Seychelles and wherever. I can do basically what he wants to do. I can do it too. But I decided that this journey is a new challenge. I have now managed to be successful and get this. Now I want to see how many other people I can take along for the ride with me, because trading is a flippin' lonely place. Once you are successful, remember I'm stuck in this four walls, and stuck in front of this PC screen with charts that does not talk back to me. It talks a different language. I get bored. So this, I enjoy it. I love it. I love having you guys in the community. I love having the group. I love being able to interact with you guys. So I think these sort of sessions I'll do a little bit more often because I enjoy it. But I want interaction. I want you guys to ask questions. I want you to get involved. I want you to understand what we do, how we do it, and why we do it. So yeah, I'm going to end the session off here. Guys, you have a blessed evening. And apologies for being a little bit absent today. I just had to deal with some personal stuff with the doctor with some injuries. So have a blessed evening. I'll see you guys rocking the charts again tomorrow morning. So I hope this helps. I'm going to post the recording. Go watch it over and over and over and over again. And please remember to copy this onto your charts, memorize it, draw it over and over and over until you can memorize this pattern. And remember this, 4 key rules: change of character, BOS, liquidity. You have to identify your liquidity, and then you look for a POI, and then you make sure you're reacting out of major levels. Simple. If you follow this, you will be successful. Seriously. Stop overtrading. Stop guessing. Stop predicting. Stop hoping, and start reacting. And trading will become easier. All right, guys, have a blessed evening. Ciao.